Australia's property market is changing fast. We have rising prices, limited supply, and changing interest rates. So today we have Peter Esho, who's a property expert and also Wealthi co-founder. And he's joining us to provide a forecast. So today's subject will be where interest rates are going, what cities will outperform the rest of the market, what will happen with migration, housing supply, rental demand. And I think we're going to wrap this discussion by discussing risks and red flags to watch out and common mistakes. Welcome, Peter. How are you?
I'm great, Tiffy. Thank you for having me on.
And before we continue with this conversation, I'm going to switch to Spanish very quickly.
Sure.
Usualmente estos videos los hacemos en castellano o en español, con lo cual si quieren los subtítulos en YouTube hay un botón que tiene una CC y si apretan ahí les pueden aparecer los subtítulos tanto en inglés como en español. So now that we have subtitles on for those
Awesome.
who want them, we're going to kick off with interest rates, which are a trending topic, right? So how do you think interest rates will progress for the remainder of 2025 and 2026?
So in terms of a little bit of context, we have emerged from a post-pandemic world. During the pandemic, interest rates were brought down to ridiculously low levels. And then post-pandemic, there was an adjustment for inflation. So they went from one extreme to another. We're now in a phase where we're looking for a normal medium-term interest rate benchmark so that the economy can function. So we are still finding out what that rate is. Clearly, the rates that we increased to, so those mid 4% rates were too high. They started to choke the economy. But I don't think we're going to go down to those zero levels. So we're in this discovery period. And what we've seen this year is 2 interest rate cuts. I think there is room for more interest rate cuts, which we can talk about together. And that'll kind of form the basis for where we go over the next few years.
Perfect. So we had a lot of stability pre-pandemic, right? It was 10 years of stability, let's call it. And I think we're trying to get there to the next 10 years of stability.
That's right.
And probably we'll achieve that stability by end of 2026, maybe?
Yeah, I think, interest rates really are a function of how much your economy is growing. So you take how much is the natural rate of growth. So in countries where there's a lot of growth, interest rates are higher. In countries where there's a lot of inflation, interest rates are higher. But in the developed countries like Australia, the UK, Europe, Canada, and the US, they're mature markets. And so the economy tends to grow about 3 to 4% per year. Now, interest rates in an economy like that will be 2 to 3%.
Okay.
So I think Australia is going from mid 4s, we were just under, but call it mid 4s, to about 3.
And it's worth noting that when we're talking interest rates, we're talking cash rates.
Exactly.
Not the interest rates where we borrow from the bank, essentially.
Exactly. So when we say 2, 3, 4, add on about 1.5%, and that's what you pay on your mortgage. Maybe a little bit more if you've borrowed more, paying interest only and what so. But add about 1.5 to 2% to the rates that we're referencing.
Okay, so we're mid-2025. For the second half of the year, we're expecting how many do you think cuts we could expect?
Okay, so the economy is slowing. Right? And really the growth engine in Australia at the moment, post-pandemic, it was the government doing a lot of heavy lifting. About 30 to 40% of new job creation was coming out of the public sector.
Wow.
And that's a big component. So markets like Canberra, for example, are great because the public service is a big component and a big part of that ecosystem.
Especially after Labor won, right?
Exactly. And since Labor won, that has basically been baked in. The rest of the economy, there's certain sectors doing better than others. So we've seen a big disruption in tech, for example. Tech was firing during the pandemic. But a lot of our friends that are engineers or in different types of tech roles are starting to see the impact of AI and that filter through into the market. Construction has been relatively weak. Mining is the big wild card in Australia. Because if mining kicks off, then there is a lot of stimulus, and so the RBA will cut less. But mining has been relatively soft. And the most recent set of numbers are quite soft for Australia. Our economy barely grew, right? So GDP was 0.2%. That's very, very soft for Australia. We need to be at least 0.5 to 0.6. Because of that, I think the RBA are now worried about what happens next year.
Yeah.
And the RBA, I think, has 1 to 2 more cuts up its sleeve this year.
Cool. 1 or 2 this year, of course, depending on numbers and how they evolve.
Yeah, I think you can count on 1 more.
Yeah.
And then they'll wait and see. But Tiffy, I think the real story is what happens next year.
Yes, 100%. So what happens next year?
I think if we don't break out of this low, sluggish growth cycle,
Yes.
then there'll be a bit of panic. I think, and the economy will start to snowball weaker. And then we could see rates coming down a bit more aggressively. So a lot of people rode that off. If you remember, about a year and a half ago, people were saying interest rates will never come down. They're going to go up, get ready for like 7, 8, wild numbers being thrown out. But I actually think 2026 could see interest rates fall even more. So another 1 to 2 cuts this year, but next year potentially a little bit more.
And how does that affect property prices in Australia?
It depends on which segment. So the segments that we like at Wealthi are the $500,000 to $900,000 price point, right?
Where there's less and less 500s in the reality, right?
It's
like they're
getting harder.
disappearing. It's harder.
It used to be 4 to 750.
Yeah.
Now it's barely 5.
Yeah.
And even the value that we're seeing in the 8s and 900s is very different to what it was.
Yeah.
So I think anything 8 to 900 grand and under is a really, really great place to be investing at the moment. Yeah. The reason for that is if you take 800 grand, for example, and you divide by how much the banks are generally willing to lend, you arrive at what the average dual income household is making.
Yeah.
Right. So if you take an average couple dual and you multiply by 5 or 6 times, which is bank appetite, you get to about 800 grand.
Which is so a couple could borrow that amount of money. It becomes
Exactly.
trickier when you're a single person.
Exactly. It's trickier if you're single and give or take. But, 8 to 900 is the natural entry floor now for owner occupiers and investors.
Yes.
And because there's a lot of investors now saying, oh, rates have actually come down, maybe it's time to buy another property, or where do I put my money? You're getting more competition in that space, and building and construction costs have relaxed a little bit, but they're not coming down.
No, nothing's going to come down, right? Like the cost of living has grown for everyone.
Definitely. And the compliance cost in Australia to build new property is only getting more and more. So what it requires you to build this year compared to 10 years ago is a completely different regime. It costs you more as a builder. And so all the new supply is coming on more expensive. You've got owner-occupiers and investors coming into the market. You've got a government that's just changed its scheme,
Yes.
the 5% deposit scheme, to make it more generous.
Yeah.
And so that's going to push the market higher.
Yeah, of course. There's more incentives for more people to get into the market with interest rates coming down. Which,
Definitely.
Cool. And so are there any specific cities or regions that you believe will outperform the rest of the country?
I think it is where there is most competition.
Okay.
Right? So where you want to be investing is, think to yourself, in 10 years' time, I want as many people as possible to be buying this property off me. I want agents knocking on my door and asking me to list my property because they have buyers and not enough listings.
Yeah.
So the markets that we really like in that sub 800-900 price point are going to be the markets where there's the most jobs, where there's the biggest ecosystem of growth infrastructure. So take Canberra, for example. It's a great market because Canberra 20 years ago was a place that not many people wanted to live. They would go to work there, they'd go to study there, and then they'd run away, right, after they find something better. Today, Canberra is a lifestyle market where you can go and live a very nice quality of life. There's a lot of jobs out there, and now it's moving beyond government. For those that follow Australian sports, Canberra's NRL team is now about to win the competition. So I say that because it's evolving. These little things are clues to what happens in the future. That's a great market. Melbourne is a great market because Melbourne still, the quality of life you can live in Melbourne is better than the quality of life you can live in Sydney if you have the same income.
Yes, and incomes are similar across both cities.
Exactly. You take 100 grand in Sydney and 100 grand in Melbourne, you live a lot better in Melbourne.
100%.
So what does that mean? It means more people are going to move to Melbourne and invest in Melbourne and rent in Melbourne. Sydney is the premier market.
Yeah.
Sydney is really a trickier market, sub 800-900 grand. And so you have to compromise a lot more.
Yeah, you have to compromise a lot. Let's call it as it is, right?
Exactly.
Like the expectation of, because I have these conversations pretty often where I have friends living northern beaches, eastern suburbs, and I live in the eastern suburbs. And if I'm expecting to be buying something for my own self in that price point close to the water, that does not exist.
Exactly.
Cool. And so there's been a lot of talk about migration and housing supply.
Yep.
How does these two affect the market outlook?
I'll touch on supply first.
Yes.
The problem we have in Australia is not a housing problem. It's a construction issue. Australia is a very difficult place to build things, right? We don't build electronics anymore. This table here is imported from China. We don't build things, right? So when it comes to building houses, the competition for labor is more fierce, right? And so the way we build houses in Australia is expensive because we make sure we pay people properly. We make sure we insure them, we train them, we make sure we care about health and safety, and that's important.
Labor in Australia is really expensive compared to the rest of the world.
Exactly, particularly construction.
Yeah.
So if you go onto an Australian job site, it's very different to a European or a North American job site when it comes to safety, and that's good.
Yeah, it is good.
Right, because we care about people. So the cost to construct is now a hindrance to our ability to house people.
Yeah.
So what's happening is that governments are trying to find ways to plan differently, is to say, okay, if it's going to cost this much to build, well then when we build, we should let people build more because you get more scale.
Yes.
If you're going to go and put the infrastructure into a site to build, instead of building 4 stories, build 10 because those extra 6 stories, we need the housing.
Yeah.
So that's what's happening at the moment. We're going through some significant planning changes, and I think over the next 10 years, you're going to see more supply coming, but it's going to be very different to the supply we've had over the past 10 or 20 years. You're going to see more vertical living, and they're going to be around infrastructure because Australia is also unique. It's a big country, and because it's so big, it costs so much to maintain our cities on a small population base, so you can't just build anywhere.
Yeah.
So we've got this fantastic infrastructure now in Sydney, Melbourne. Brisbane's catching up, but it's not there yet.
Yeah, you're mostly talking about trains, I'm gonna guess.
Exactly.
Okay, like light rails and then trams, whatever, metro, everything that is connecting people to CBDs and...
Definitely. And there's only so many $10 billion train lines you can build.
Yeah.
Right? You can't just keep doing 10, 20, 50 billion. You run out of money. So the government's of this view is, hey, we've laid out all this infrastructure.
Yeah.
We now have to build around it. And so to build around the homes that we're going to be living in are going to be different.
Yes.
So the cost to produce an apartment, the cost price for a builder to build an apartment today, just the building without the land is about 400 grand. That's before you take into account everything else. And so in Sydney, when you see a 1.2 or a $1.5 million apartment, it's not necessarily a developer or a builder trying to be greedy. It's the reality of how much is the cost price plus the economic return. So to answer your question, I think we'll start to see more supply, but different and more expensive supply.
Yeah. And what trends are you seeing in the rental demand?
We're starting to also see a difference now in the post-pandemic world, where during the pandemic, everybody wanted space, backyard. They moved away from apartments.
Even regional.
Exactly. People were running away. They wanted ocean. They wanted, a place for the dog. And then people have started to realize, particularly millennials, they're starting to realize that they value lifestyle. They like to go out. They like to travel. They like to be quite agile. We don't buy super expensive furniture like our parents' generation. We live lean.
Yeah.
And that lean lifestyle in a house isn't necessarily sustainable because houses are expensive. You need to maintain them. So we're moving more back towards apartments, townhouses, less maintenance.
And especially what I've been seeing is that the household size keeps getting smaller and smaller. So more people don't have kids.
That's right. We're having children later, which is happening all around the world, not just Australia.
No, it's just...
And so that, going from an expensive 4-bedroom house where you no longer need those 2 extra rooms and you don't want to pay $200 a week to mow the lawns and everything else, back to an apartment where you can go eat out, train at the better gyms, and you don't want to be stuck in traffic an hour and a half each way commuting to and from
100%.
work. Because we're now back in offices.
Yeah.
and it's not like everyone's working remotely anymore. So to answer your question, the rental market's heating up more, and people are compromising more. And I think the markets that were kind of doing well in COVID, that shift is going to come back.
100%. And so what are the risks and red flags you believe investors should be watching closely this year?
Rule number one, be very aware of what you can afford.
Yes.
Okay, and you need to be realistic with the market. So it's becoming harder and harder to buy a property, right? And that 100 or 150 grand deposit that you might have, some people might have less. They might have 50, some people less than that. But let's just use 100 grand.
Yeah.
You have to be realistic with what that gets you. And you have to be realistic with what you can afford. Because you can go and borrow money, but you need to be able to service that money. So you need to be very aware of where the market's at, because where the market was 5 years ago is different to where the market's going to be in the next 5 years.
Especially as we just briefly mentioned the whole 5% deposits, and you're borrowing 95%. If you are buying an 850K property, something like that, and you are borrowing almost 800K.
Yeah.
When you're doing P&I, that's around, I don't know, $5,000 per month.
It's a lot.
It's a lot to be paying almost all of your income. And it becomes really tough if you're living that paycheck to paycheck just because you wanted the dream of your own home.
Definitely. And that's why the government removed the income cap.
Yeah.
Because they realize that you need more income now.
Yeah.
Because properties are more expensive.
Yeah.
So rule number one, be aware of how much you've got and what you can afford.
Yes.
Rule number two, don't shoot for perfection straight away, right? Have a very, very sensible, pragmatic approach to property investing. Not everybody opens up a share trading account and expects to invest $1 million straight away. A lot of us open it and put 50 or $100 in. We test the waters.
Yes.
Same thing about real estate. You don't have to buy your first property doesn't have to be the most perfect one.
Yeah.
And the property you buy today isn't the property that you're going to die in or retire in, right? There's a process. There's enough time. We have a lot more time than sometimes we think. So go for what you can afford. Start off, get in the market. Third point is be prepared to take pain and have a high threshold for inconvenience. Because everything in life that you do that's worthwhile comes at a cost. If I want to go and open up a business, I need to be aware that business is challenging.
Yeah.
I can't go into it and expect everything to be cruisy and have a low threshold or tolerance for inconvenience.
And especially when you're just starting, right? Like the first year for any properties, like you're trying to get used to income expenses, it's always the hardest one.
Definitely. And it's a learning curve and you get better. And if you surround yourself with good people, you have an ecosystem of good, trusted advisors, and you realize that this is a long-term thing, right? The property you buy today, if you don't get the returns today that you want to get, doesn't mean that you won't in year 8 and in year 13, right? In year 13, from year 13 to 14, you can make more money than you've made from year 1 to year 12.
Yeah.
But we just don't know. Is that in 13? It could be in 4. It could be in 1.
Yeah.
But it could also be in 19. So you're in for the long haul.
Yeah, especially now that it's good when we're talking about, for instance, cost of living coming up. It doesn't just grow every year in the same fashion, same way, right? So you might have 10 years where inflation was 2%, 2%, 2%, and suddenly you went through a 8% inflation. And then after that, it starts accommodating again to that 2%. And maybe you have to wait for another market cycle. But the people who had held properties for 10 years, by the time that they achieved that time, where rents massively grew to match the inflation, like that, your cash flow massively changed.
Yeah. If you take, for example, NVIDIA stock, and you have a look at NVIDIA was a business that was around making chips for gaming for a very long time. A lot of smart investors went in for gaming and held it.
Yeah.
And then they sold it right before it took off when AI came out. And so about 90 to 95% of the gain in NVIDIA has been in a very short period of time. Same thing can happen to real estate, right? You can be holding, slugging away, paying your strata, paying your whatever, thinking, oh my God, but That's the beauty of real estate investing. That's where there's opportunity. But if you're going to get in, have that patience.
Yes.
In the same way that no one goes out and opens a business. And a lot of people say, you know what, I'm happy to lose money in the first year, right? Or I know I won't make money until year 4 and 5. It's the same with real estate investing. Have that patience, develop a good ecosystem, be very aware of what you can afford, and where you start isn't where you end up.
So final question to close off. Anyone who's watching this and considering buying a property, but they're not sure if it's the right time, what would you tell them?
I think it's always the right time to be making the right decision. I think start off with what you can afford. If you can't afford anything yet, that's fine. Figure out what it takes to afford to get into the market. If you can afford to get in, it's a good time to get in, form that base, because as we said, there's more supply coming, but it will be more expensive. As cities are going to change, the property profile that we've been building is going to change. And Australia in 10 or 20 years' time is going to be very different to today. So if you have the perseverance and if you're serious about building some great wealth, it's a great time to be getting in, and rates are coming down.
Perfect. Thank you so much.
Thanks for having me.